Financing decisions are the second type of decisions in financial management. In the first type of decisions, that is investment decisions, you have decided that yes, the business needs the money. In the financing decision, you need to decide on what will be the source of the money. The business can raise money through shareholder funds, that is equity capital or the share capital, or it can be through retained earnings, that is retaining the profits that would have been otherwise paid to the shareholders as dividends. The advantages here are that no interest needs to be paid on this money and there is no obligation to return the money. The business can also raise money through borrowed funds, that is loans, debentures or other forms of debt. Here, timely repayment of the principal is required and also interest needs to be paid on the amount that has been borrowed. Which means that there is a risk that if the business is unable to generate enough cash flow or generate enough returns, it may be unable to repay the principal or pay the interest on the loans. This risk is called financial risk. Before making financial decisions, some factors that should be considered are cost, because raising funds through different sources has different costs. The firm should evaluate all the options and should normally choose the cheapest source. Risk. The risk that is associated with each source is different. Debt has the highest risk because principal and interest needs to be paid regularly. And equity has the lowest risk because there is no interest and no repayment of principal. Flotation costs. Higher the flotation costs, such as cost of processing or transaction fees, the less attractive the source will be. Cash flow position, that is a stronger cash flow position. That is, if a business can generate regular and adequate cash, then it may make debt financing more viable and more attractive than funding through equity. Fixed operating costs. If a business has high fixed operating costs, that is building rent, insurance premiums, salaries, etc., which have to be paid regularly, then it must reduce fixed financing costs because the principal repayment and the interest payments will also eat into the cash flow. Hence, lower debt financing, that is minimizing interest payments, is better. Similarly, if fixed operating cost is less, then more of debt financing may be preferred. Control considerations. Issuing more equity may lead to dilution of the management's control over the business. Debt financing has no such implication. So companies which are afraid of takeover bids would normally prefer debt over equity. State of the capital market. During the period when the stock market is rising, called the bull market, more people invest in equity or shares at a premium. So raising money through shares is more beneficial for the company. However, depressed capital market, called the bear market, may make issue of equity shares difficult and it will be less lucrative for any company. So all of these factors have to be considered before deciding whether to raise money through equity or through debt.